Henrik, thank you very much for joining us today. How are things in Copenhagen?
Very warm, at least for Copenhagen standards, I would say. So 25 degrees right now, but very humid, which is a pain for me. So that's very hot for me here.
So overall, your summer's going well?
Yeah, I think so. I think so. I have had a couple of good week of vacation with my family, and we went to went also to see Felix Zulauf, which is a great economist that I know you also have had on the show here, and yeah, I enjoyed talking to him.
Oh, good. I'm going to ask you about that later. But before we do that, I want to recap what's happened here in the last few months because the last time you and I spoke, it was late March. I can't believe it was that long ago. But oh my God, so much has happened since then. And that was just a few days before Liberation Day, which was April the 2nd. And we had a massive sell-off in global markets. The S&P peaked in February at 6,100 and went all the way down to 4,800 by early April. And I was shocked to see you take your target price at that time when we spoke in late March. You took your target price from 6,100 to 6,800. And I just didn't think it was, I thought it was unattainable. And I actually thought you were losing your mind. But I got caught up in this whole narrative that these tariffs would lead to this global trade war, and similar to what we saw in the 1930s, and we'd have a massive sell-off in global markets. But you were right, and I was wrong. So I'm curious to hear your stance now on the S&P. What are your thoughts? Where do you think it's going? What's your target as we go into the back half of the year?
Well, I think I've been talking about a summer doldrum for some time also, and I still think that is going to come. I don't think we're quite here, and maybe the summer doldrum will be more of a late summer doldrum. I mean, whatever September is going to be. So maybe into September. I think there's going to be this pullback. I don't think it's going to be the big top here at this point. I think we're going to see another very strong rally, as I've talked about previously also. And the 6,800 is very much. I mean, it's a minimum. I mean, 69 is 70,000 maybe 70. Sorry, 7,000. Sorry, I'm 77,000. So I can see that. But also even with a extreme top developing, maybe even 7,500 on the S&P. So. I think we are in a situation here now that people come back from the bottom in April there and now thinking everything is fine, and I think that is the big misconception here.
So overall, you're still bullish as we go into year end.
Oh yeah, whatever September. Yeah, I think again we'll also have to see what kind of top we'll get into September, because if we get the most bullish one that I could see with a very strong rally into 7,500. Then I could see something that could probably also become more of a an Eiffel Tower kind of spike. That is not my main thesis here, but we'll have to see. Again, it can develop very, very explosively into that final phase here. So into that part, but I don't think necessarily the Q4 was going to be a great quarter.
And those numbers aren't too far off. A lot of analysts on Wall Street, depending on what their numbers are, but let's just say they have earnings of $300 for the S&P. If you use a 22 times multiple on that, that takes you up to 6,600. If you take your multiple up to 24 times, that takes you up to 7,200. So those numbers are in range with a lot of people on Wall Street. But we are in the middle of or deep into the Q2 earnings season, and for the most part, the numbers have been pretty good. JP Morgan, Citi, Bank of America, Goldman Sachs have all come out with record numbers. Netflix numbers were pretty good. We've seen some weakness out of companies like Tesla, but according to Fact Street or FactSet, 83% of all the companies in the S&P that have reported thus far have beaten expectations. So things are looking okay. And this compares to Q1 when we saw the numbers, like everybody that reported Q1 numbers, there was so much uncertainty associated with tariffs and everybody was taking their guidance down. And then here we are a few months later, and it seems like this sense of normalization is coming back to the marketplace.
Yeah, you can be very right on that. And again, when it comes to the earnings, I mean, there are so many ways that they can also adjust their earnings in the way that they need it to. So we have to see. But I think again, I don't think that there's problems with the earnings at this point here in the businesses. It looks strong, as we said, and the bull market is ongoing, and there's for many reasons. And again, also if you look back in April when everybody was running away from everything and just throwing it on the floor, it was a similar situation. So again, the panic that sometimes develop is something that I want to step away from. And right now, I think people are right. I mean, things are looking great, or good, I would say, not great, good. And I don't see any reasons why we should see a top here. So, but yeah, we'll have to see what the earnings are giving us.
And once again, so you think we're going to see this top in the S&P before year end?
Yeah, I think there's a pretty good chance of that. Again, I don't want to do the time. I'd rather say the levels, and the thing is with this, when you have a kind of I said a Eiffel Tower kind of move, then of course things can shift time wise. But I think we should look at the bigger perspective here, and the bigger perspective is that we have an economy where from around the world, you'll see that the central banks are now stepping in to try to support the economy. We see that the Central Bank of Europe, the ECB, has been cutting rates quite a lot. We have a housing market in the US that is frozen solid. The application or mortgage applications are down in the gutter still. We don't see the consumer sentiment confidence is fantastic here. So I think there are a lot of things that is just suggesting that, the financial market is one thing, and that can be a lot about the money that is being sent into the system, but it's not the same thing as the economy as well. And I think the problem with people, with a lot of people here is to understand that the financial market may be front running things in the economy to a certain degree, but when there are also times, and we know that when we have bubbles, that things are coming a little out of sync on the financial market side, and then the real economy really catches up to it and tells it, this is not where we gotta go. So I think right now, if you look at that, you will see the euphoria in the financial markets is not supported to the degree that it should be in the economy, and we have seen this before. I mean, we have seen it before also where things takes a little longer before it actually rolls over, but it's the same thing. We have a stalling engine, and I think that is a very it's a big thing, and it's something that will lead to a top in the stock market sooner or later. But again, yes, I'm very bullish right now. We'll have to see when the top comes in. 6,800 will be first, 69, 7,000 ish will be the first level. And then if it blows right through that, then 7,500 ish, and then we'll see what happens there. But don't get confused about bond market, sorry, the financial markets and the real economy. And now a lot of people seem to believe, and that's again also what we've seen before, that liquidity will save the day, and that we can just see the economy growing.
Yes, and just because you brought up the economy, why don't we go there now? Because I have to admit, I'm shocked by how resilient this economy has been. And you look at the shocks just in the last 5 years. We had the shock from COVID in 2020. Then we had interest rate shocks in 2022. And then we had the trade wars and the tariffs in 2025. And we had these pullbacks, quite significant, anywhere from 20 to 30%. But within a short period of time, the market just catches a bid. And to your point, it all has to do with liquidity. And it's amazing what you can do with a few $1 trillion if you start injecting it into the system place. But to me, the overall economy and the numbers we've seen this year thus far, the economy looks okay. It's GDP's around, I don't know, 2.5%. The unemployment rate, once again, I'm surprised to see it hanging in around the 4% level. What are your thoughts on the economy here? You did express a little bit of concern about it, but what numbers are you looking at that gives you a sense that the economy is not as strong as we're led to believe it is?
Well, if we look to history, first of all, we know that when the labor market really starts to take a hit, that's when we're really close to things. So that's when we didn't see that in 2007 either, before we actually get closer to the recession in December of that year. But what we do see is that looking at the continuous jobless claims that comes out on a weekly basis, you'll see that the number of jobless claims and new jobless claims is not really high. It's actually historically low at this point here and been for quite some time. But you're looking at the continuous jobless claims, you actually see that that's actually climbing. And that is not a good sign for the economy. I mean, that is a sign that people that actually lose their jobs will have some problems in finding a new one. and it takes longer for them. So you don't want to see that. And actually, if you look at the charts like that, there's a clear, trajectory there that takes us higher on that. We'll have to see how that develops. It is now, as I said, climbing. If you so these are some of the things that you can look at for in terms of the on a weekly basis to say, well, where are things developing? And I think that people are again thinking, okay, GDP numbers are great. Well, again, GDP numbers can also be they are actually lagging, and we know how they can be revised. And the Fed was, famously also standing in October of 2007 and saying, oh, we see moderate growth. Nothing should be actually, we don't see any problems with the economy at this point. At a time where you saw the economy actually dropping by 1.6% in the fourth quarter of 2007. So when we look at GDP, we have to understand it will be revised. It's very heavily dependent on net export, also as we saw in Q1, where everybody was again talking about now we have a recession or something because we saw a bad number, but it was because of the net export because of the what the tariffs were doing to people's expectations and what they did. So no, right now things are great, and that's also why otherwise I would not be bullish. Things are great. What I'm saying is that there has been a severe moment of inflation and rate hikes, and market yields are up high, and you see that the whole housing market is really not in a good state. And yes, labor market for now is still holding high, but there are the first signs that you see with this, as I said here. And again, if you look at this, I mean, in order to have a soft landing, because that would eventually have been what we should have been talking about here, then you should have seen also that the yield level should be coming down. People should not be stressed with also again with the credit card delinquencies that we are seeing and all types of loans actually starting to see those kind of delinquencies. And that is the sign that the consumer is not well. So I know again, and this is the schism here. There is the financial world. They're just go go go, and it's all is good, and the economy is strong. And then you have the real economy, which is the Mr. and Mrs. Johnson or whatever they called in Canada. Here will be Mr. and Mrs. Jensen, and they are not necessarily as well off. They don't necessarily have a problem right now, but they are feeling the heat of the high yields, which is then taking some of their buying power out of it, and they will have to reduce their their spending. And slowly we're also starting to see an adjustment in the capacity of certain companies, because after COVID everybody was building up capacity because everybody was doing great. And now it's starting to dawn on certain industries also. Well, maybe that demand is not really coming back. And guess what? It was based on a massive stimulus where everybody was going out and spending money. And it takes some time to get through the system. And then you'll see inflation as well also. And that is also staying. It's not a problem at this point as I see it, but the levels we have seen. So there's a difference between the changes per year and the level that we have reached. And yes, things has gotten more expensive. So I think we're depending on where you look. If you look to the financial market, they'll be cheering, but you've seen this before. We saw that movie before, and if you look to the consumers, it does not look like they are cheering that much. And I think that is the big schism here. And if you depending on where you focus, well, if you focus on the financial market, yeah, everything's great. What's not to like? And then you have the other side. I tend to look more to the real economy.
And I get your point about the numbers that come out of the government because whatever they say, I just depending on the number, I either double it or I cut it in half. So if you're looking at GDP, if they're saying it's growing at 3%, I just cut that number in half. If they say the unemployment rate is 4%, I just double that number, so it's more like 8%. But you're talking about the consumer, and they represent 60 to 70% of the US economy. So what the consumer does is very important. But once again, I'm going to go back, I'm going to push back a little bit, and I'm going to bring
No.
up the US financials. JP Morgan just came out with their Q2 numbers. Record numbers right across the board. Bank of America, Citibank, same thing. Goldman Sachs. Both JP Morgan and Goldman Sachs are trading at all-time highs. And when I look at the banks, they're really a barometer for the economy. They deal with retail customers, they deal with commercial, and they deal with institutional investors. And so when you look at these things, you got to think the consumer's doing okay. If they weren't, then we'd see the banks. It would show up in the banks first, I would think.
Yeah, and if we look to it, I mean, one of my idols is good old Warren Buffett, and he has been taking most of his chips off the table, especially when it comes to the banks, because he knows that those are the first one also to get hit. And as I said before, I'm not saying again, I'm saying things are going to get dicey at some point down the road. We are seeing a very, very strong bull market right now. I was also very, very bullish in April, and now we're here where everybody starts to say, well, everything is fine. There's nothing can hit us. It's always like that. There are certain things in life that, when it feels the best, it's almost over. And I think this is one of those things. That's the economy. When it feels the best, that is often where we see the highs. We also remember that in 2007 for the one of us that was, trading back then. So I think it's again, you will always have this situation, this kind of you can call it twilight zone kind of thing, where things are maybe not as they seem. If you look again through the lens of the financial market, and everybody's just partying because what's not to like? The stock market's going up. But again, I just want to focus on the numbers that we see from the consumers are not good, and the housing market is really bad. I mean, the affordability is down to what we saw in the 80s. It's even lower than what we saw into the financial crisis. So obviously, I mean, these things can go on for quite some time, and we can then have a discussion about whether liquidity and the markets will eventually pull things higher. I doubt that, because I think, again, as you said, actually, I think it's closer to 70%. That is the part of the GDP, the consumption of consumers. And I don't see them actually going out and spending a lot and being, all or, happy about the situation here. And that's the problem. Again, we'll have to see how that develops. But when things are moving up as fast as we see right now, and you can look at the market, I call it a blow off top, and we are in that. I mean, I've said it all along. Whether by the end of that, you're going to see the markets rallying very strongly, and you'll see liquidity being the main driver of this. We are slowly getting to that point, and there will be a twilight zone where everybody will think, oh, but for things are fine. And then we can say, well, this time Mr. Buffett is going to be wrong, and he's actually, he's going to have to put his money back into the market. I don't think he's going to be wrong, and I think it's because he actually studies, or he has studied. I'm the one that studies, but he has studied the business cycle and understands that when we start to see these things, when inflation moves up like that, when the consumer is struggling with yields levels and having to work 2 or 3 jobs to make ends meet, it may be that the stocks will go up for a certain while, and people may even think that the stock market will lead the economy. But if you really look into it, you can actually see that when the unemployment rate starts to bottom out and move up higher, even though it takes a breather for some months, as it also did into 2007. Actually, that is what you need to focus on, and that is leading the stock market. But again, it takes people to actually go and look to discover these things.
Well, as you know, I'm based in Toronto, and our economy has been weakening for many years now. Our unemployment rate across Canada is 7%. In the province of Ontario, where I reside, it's 8%. And in the city of Toronto, it's approaching 10%, if you can believe
Oh,
that.
wow. Okay. Didn't know that.
Yeah, youth unemployment is at 14%. Youth being, I think it's 16 to 24. Okay. It's at
Hmm.
14%,
Mm.
countrywide. So our economy is definitely weakening. There's a number of other reasons why that's happening, but this trade war that's going on with the US is another big negative
Mm.
too. But it's a real mess here, and it's starting to impact the real estate market, to your point.
Mm.
And
Mm.
just in the city of Toronto, we have, I don't know if you've been to Toronto in the last 5 or 10 years, but
Fortunately
major
not, no.
major
Hmm.
condo development going on. Okay. I don't know if you've heard of this, but there's a crane, it's called the Crane Index. It measures the number of construction cranes across major
Mm.
North American cities.
Hmm.
And Toronto is number one on that list. There's over
Okay.
100 construction cranes. The second
Yeah.
largest city would be LA with 42. So it gives
Wow.
you
Okay.
an idea of what's been happening here. But these condos, you cannot give them away now. Okay.
Mm.
Last year,
Yeah.
30,000 units came online.
Yeah.
This year, it's 30,
Yeah.
another 30,000. Condo sales are down 30% year over year in Toronto. They're down
Yeah.
20% year over year in Vancouver. You just
Yeah.
can't give these things away. So it's really starting to show
And
up. And I think
again, I mean, this is a slow moving thing. And we saw it in 2000. I mean, Michael Burry, he was out, I think, 2006, 2005, 2006. And he was, famously way too early onto this, but he was focusing also on the housing market. And the housing market is one of the leading things to the economy, because that is first where you'll stop to invest. I mean, if you're getting a little squeezed on your finances, then you're probably not starting to, do that renovation of your on your house, and that's why it takes a hit first. And if we look at all these things, you can actually see it for the U.S. It's just taking a tumble, and it's down at the lows, and we can sit here and say this time is different. I'm just getting too old to say this time is different when we have seen this before. And there's nothing this time. And we hear people saying, "Oh, but the Fed is so much wiser now." I mean, really? We're talking about the same Fed that was stimulating the economy right into a supply crisis, and creating an excessive demand and believing that the inflation would stay below 2.5%, and it reached 9.1. Are we really saying that they are in control of this? I don't think they are. And I think we're just seeing this in slow motion, and people are getting, oh, didn't happen yesterday, it didn't happen today. And, all these things are it just doesn't work any longer. And now we're just in liquidity, and the Fed knows what they're doing. I think we are in a world where things are slowly deteriorating, and it's going to be something we'll feel later on. And people say, yeah, but when? The levels in the stock market, I think, is going to be reached, but the slowdown in what I call the balance side of the economy, the housing market. There are two major markets: that the housing market, there's the labor market. Housing market is showing clear signs of deterioration. We now need to see that in the labor market, and we're starting to see the early signs in terms of the continuous jobless claims. Also, and you said youth employment there in Canada. Also, if you look at the number of weeks of average unemployment, average number of weeks of unemployment, you'll actually also see that is also moving higher, and it's actually way higher in the U.S. than it's been going back before 2009. Again, not a sign of a healthy economy. I mean, you would like to see that is declining, and actually not being at the high levels that we have now. So things are holding together, I would say, but that's a different thing from actually having a strong economy. And then there are the whole financial side, the liquidity side of things.
Yeah, remember when the Fed said that inflation was transitory?
Yeah, exactly. Yeah, but again, and these are the people we now say, oh, but they know what they're doing. I think we have come to a point where people think that liquidity will do the whole difference, and that's going to be the salvation of everything. But the problem is simply that liquidity cannot solve a solvency problem, and that is what we will start to see. Because if the whole era here of low interest, era with low interest rates has simply brought about valuation levels that is unattainable and unsustainable for people. So when you want to go out buy a new house, I mean, you cannot afford it with the current interest rate. So you have to stick to your own to the house that you have right now. And if you're now, you can maintain it, you can sit with it, but the problem is if you start to lose your you will not be able to do so. So people will, of course, that's the last resort, is starting to sell their homes, but it's something that I could see coming as we start to see the deterioration coming in. So I think people need to look more under the hood. And in my business cycle model, there is the Titanic has hit the iceberg kind of moment, which is when you see yields moving up, yield spread and so on are inverting, and then starting to move back up again. And that's what we see now. It's taking longer for two reasons. One is we have had so much more savings after COVID because everybody has got some money on their bank account. And secondly, also because businesses were building out capacity. And one thing you don't do as a business owner, you don't build capacity one day and take it down the next day. So they have also tried to extend it. Those two factors has then pushed the whole situation out further, longer than most could expect. Expect, and but it doesn't. It doesn't solve it. It doesn't solve it.
So you have said in the past that you believe the Fed is way behind the curve, and we have this ongoing battle going on between the president and Jay Powell about cutting interest rates. And just to summarize the administration's viewpoint is they have $37 trillion in debt, interest payments are $1.1 trillion a year, so they want to get the interest rates down. So their interest expenses are significantly lower. They have trillions of dollars of bonds coming up for renewal here this year and next year. And of course, they want to get those interest rates down so their interest expenses are lower. But what are your thoughts here? Do you think interest rates should be going lower? We have a Fed meeting coming up next week. Do you think they'll cut?
I think that again, it's quite. I have a chart actually. I'm just sitting here thinking about that right now. Where you, if you look at the consumer confidence, which has been plummeting, like what you've seen before when you have a recession, we have seen a very clearly defined bottom in the unemployment rate, which is now moving higher. And especially if you look at the number of unemployed people, not in the rate so much, but number of unemployed people, and especially also if you look at continuous jobless claims, you are clearly seeing well-defined bottom and things are starting to deteriorate actually to a degree which is worse than we saw before the financial crisis. And if you look into the business cycle model and you look at the number of, also the latest ADP report showed us a negative of minus 33, negative 33,000. I mean, all these jobs that that's been created in the US, a lot of those have been created in the governmental sector, and are they really the kind of jobs that will create long-term value? It will. I mean, it's like in Denmark here we have a lot of people working in the governmental, but I'm not sure that that's what you want to see, and especially if you look at that. The private jobs are actually coming down quite strongly, and to comparing to just compared June 2007 and 2025, we are almost at the same par with when it comes to the non-farm payrolls and everything, the unemployment rate and so on, inflation rate and everything. And back then, you also had my leading indicator, the Titanic moment had flashed already back then. It has done the same now, but then in June 2007, we have to remember the flashing of the recession indicator from my side, or that it's the Titanic moment. It's not when the recession sets in; it's that it's coming. It's inevitable. Was in November 2006, and then at least it lasted a year until the recession then set in. But and the coincident indicators index actually showed that for November, and it's actually turned out it was December that we saw the recession. Right now we're in June, and we are comparable to what we saw in June 2007. And back then there were also some small things coming up here and there, but it wasn't like there was a big thing having hit just yet. And you did see also that the stock market went on to rallying into October. Could I see a top in October like we saw back then? I could see that. Could I see a very strong stock market into that? Yeah, sure, because we have not so much more liquidity going on, but it's not the same thing as the economy as well. And liquidity will create inflation eventually. Inflation will crush the consumer. So if they think they can throw more liquidity on this fire here at a time where I see the long-term cycle in terms of inflation has now moved into an up cycle, which means that there's a new inflation regime. I think they're going to be very surprised what actually printing money or delivering more liquidity to the system is going to cause this time. I think it's going to cause inflation, and that is going to be very difficult for the central banks there, because you can't stimulate the free lunch, there will be maybe a short bounce of this, but when they need to set in again, or to stimulate again with that more massively. But the thing is, the times of the free lunches are simply over here, and I think you're going to see that it'll create a completely different environment.
Yes, and no, inflation has not gone away. That is for sure. And I don't think we're ever like this 2% target that the Fed has. I think they're totally wrong. They're going to have to increase it to 3%. And inflation's killing everybody. Like I know, like myself, I used to go to Costco and drop $500 on groceries, right? And that would feed us for quite a while. Now it's probably more like
Mm,
$800, right? And it's just, God, what I'm paying for things, it's just killing me. And here's another fun fact for you, because it's almost like we got this bifurcation within our economies. The number of billionaires in the US in the last 10 years, it's gone from 500 to 2,500. Okay. Just think about
mm,
that, from
mm,
500 to 2,500 billionaires. In the town of Aspen, which is in Colorado,
mhm,
there's
mhm.
100 billionaires. All right. But
Wow.
then at the other end of the spectrum, you got people like me and you that are just trying to get by. We're treading
Mhm.
water, right? Just to try to keep up. I'm making the same wage now that I was making 10 years ago. Right. And I think that's the
Yeah,
case
and then you
with
have to pay more for your
most
grocery.
people.
But I think that is a fair picture of how many people see the situation. I mean, they haven't seen a lot of huge raises on their payroll and or their pay slip, and and they still have to pay more. And that was my point on that things are becoming difficult for a lot of consumers. And I think it's not something that's going to develop over a day or something like that. People have a tendency to think that we need a trigger. What's the trigger, Henrik? I'm all the top and said the trigger is actually the toxic environment that is, that the high interest rate yields are creating. And it's at some point it's starting to say it's Mr. Jensen first who cannot, and then it's Mr. Johnson, and then it's all these. They'll find it difficult to actually meet payments, and they'll cut down on certain things, and you just have to look at that in the broader perspective, on the very macro perspective, and that is the what is actually causing the slowdown. That's why you have business cycles, because they are actually well defined. If you just the way I do it, and you just see when they roll over at some point, it's gonna be something bad. And we are getting closer. The trigger will probably not be something big, but the environment that it will be caused, like in 2007, December, we had the recession start. It wasn't until March of 2008 we saw that Bear Stearns were in problems. And then we saw in September of 2008 that the Lehman Brothers and our others were wobbling. And I think the people saying, yeah, but everybody's doing well now. Look to early 2007. People, there weren't a lot of crisis mood in the financial sector back then, and that's what I think we need to look to. So I think people are dismiss things because they don't understand the economy, and it's we are so much wiser, and liquidity this time will solve everything. You know how many times we've heard that? Every time before any big, and liquidity was going up into the financial crisis as well. It was up from 2003 up to 2007. It was up 30% on the balance sheet on the Fed, which was quite a lot back then. And then into the financial crisis date, it just rocketed higher. Did that prevent the actual worst recession we have seen since the 1930s? It did not. It did not, and it took a while, and there was a lot of defaults and so on. And I think again, that's what we're seeing. And it takes a while, and people becomes, come up. This time is different. It's so easy to say this time is different. It never is.
I recently saw an interview with Jeffrey Gundlach of Double Line, and he believes there's an economic reckoning coming. And his whole view is that in April, when we had this massive pullback in the equity markets across the globe, we also saw a fall in the US dollar, and we also saw a fall in bonds. And typically, when you get these sell-offs in equities, you see this flight to safety into bonds, right, or government bonds. But we didn't see that this time. And he thinks what's happening is that people are waking up to the fact that we got this massive debt level in the US, interest payments that are just going up and up and up because at one time the average coupon in the US was 2%. Now it's 4%. And once again, like I said, there's trillions of dollars of bonds coming up for renewal. They're going to have to refinance these at higher interest rates, and that's going to cost trillions of dollars. And it sounds like you're of the same mind.
Well, I think he's a little too early on that call, and who am I to actually say that? But I think he's a little too early on it because it's a very natural thing. Again, also if you look at the yields into going into previous crisis, you will always see that the yields levels are lacking indicators, which means that the economy, when it starts to roll over, you'll see that yields are coming down. And again, so he thinks that I would have been worried about what he's saying if the stock market had been crashing and you saw the same thing. Then I would be worried. But the situation right now is not that. You actually have a soaring stock market. You have the crypto market. You have a lot of places where capital can be going. So it's not like that's not the situation. The situation is really that the business cycle has not come to the point where you see that the economy rolls over to a significant degree and people are starting to become risk off. Because if it did at that point, then I would be worried. I do think, though, that we're not going to see new lows, as I said before. If we look at the 10-year yields on US government bond 10-year yields, you'll see that actually that has been a shift. There's moved up into a new level. There's a momentum shift that we haven't seen the likes of for the last 40 years, where it was the shift to the downside after Volcker came out. That's why I call the 2020 stimulus coming, from across the world was really the inverse Volcker moment. This was the moment where we thought, okay, we can do anything we want. We can just throw money out there and it will not become a problem. There will be no inflation. That's basically what they did. Then inflation became a problem. And now it's slowly coming down again, and the Fed saying, oh, we got a soft landing. You have nothing of a soft landing because you don't have the consumer there. So that still means that we're now still in the process of seeing that rollover, where people becomes really impatient, and it's not happening. Hence, it's not going to happen. That's their argument. That's how they argue, right? So I think we will see inflation coming down much more. We're going to see yields coming down, but I don't think we're going to see new bottom for that. No new all-time lows. We're not going to see that. So I think we're going to level out at a lower level, but the deflationary bust that is coming first, things like now is not going to develop into stagflation, because to get stagflation, you need a lot of money to chase the few, and you need actually the consumer to start having those money in hand at hand. Excuse me. So I don't think that is the way, the path. The path will probably be that you see a top in the stock market. You'll see that the economy rolls over, people start because the unemployment, the Fed will come back in, and then I think you're going to see that we will see a higher level where the yields will start bottoming out at. And then you'll see Jeff's forecast of higher yields. And I think we need to start looking at what we had to do in the 50s and the 60s in terms of of getting good returns on our investments, because the situation is much more like what we had there, with an inflation going higher than inflation staying low or going lower. It's going to go higher over the next many years, but we are at a point where I think there will be a drop in it, because of that deflationary development. I think we could see when things are starting to crush, and which I think they will.
So Gundlach was also saying he no longer believes government bonds are the new flight to safety asset. He thinks gold is,
Yeah,
and this is something else where
yeah.
him diverge. He's very bullish on gold, and he thinks that's why it's had such a big move, because it's a new flight to safety asset. What are your views on gold now? The last time we spoke, you were negative on it.
No, but I think everybody can see that it's been moving up higher, and even silver and platinum have made a move, and people can now start to say, oh, but now they are making a move as well. I still look at the Barrick gold miners. I still look at the GDX. They are not moving up significantly to the degree which you would expect by what the gold market has been doing. I think there are a lot of people out there that believe that this is that this is the big move, and they would be right if we were directly in a stagflationary environment. We're not, because inflation is at 2.7. Sorry, the unemployment levels is 4 point, was it last night? 4.1, I think it was now, right? Again. So we are not in the stagflationary environment at all. We are in an environment where people are front running these things and saying, okay, now inflation comes, hence I need to buy gold. And I think that is front running things. Looking at the chart for silver, looking at the chart for platinum and the likes, but especially silver, it looks like something of a top coming on a weekly basis here. It's a very grinding move higher, which to me is and with a negative divergence on the technicals, on momentum, which tells me that there's top coming at some point. And again, I see the dollar rising to 120 or 122 on the Dixie. And I don't think you're gonna like to hold gold at that period. So yes, gold has been moving higher. I take that, but it's not the 5 times higher that we saw back in 1977 into 1979, where we had the real stagflation. That was 5 times higher in the 2 years. This time around, it's gone up from the levels we had in 2015 to the levels where we are now. Could it move a little higher here? Yes, I could see that, but I would not be holding any of that into a Dixie rising to 122 if that's what we're going to get. Now people are saying, "Oh, but Henrik, you haven't been paying attention because the dollar is now crashing." I was standing there in January saying, "We're going to have a lot lower dollar. The Dixie is going to crash down to 96, 97." I said, "That's where we are now." It's not bottoming over one day. This is a very, very significant bottom. So the bottom it's putting in now is something that's going to last for, let's say, 2 months or so. And when it starts to move up from these levels, then the next dollar bull is going to be here. And mark my words, next time we talk, if it's into the autumn and maybe into the winter, the dollar is much higher than where we are now.
And why do you think the dollar is going to catch a bid?
First of all, because if we have a sort of a deflationary bust, first of all, there's the technical side to that where it tells me that it's quite clear there's going to be a very strong rally in the dollar. But there is also, if you look at it from the fundamental or the economic side, you'll see that there is when the economy starts to slow, there is always a need for, and especially if there's a recession coming, then you'll see that the dollar is where most of the debt in the world is denominated and that means that people have to close those, and there will be a demand to get those closed, and so on and so forth. And I think it takes it too far for today, but I think also the whole situation with the cryptos market can become a situation for where gold actually will, sorry, where the dollar is actually going to rise very, very strongly. Because I think that's a bubble also that will burst at some point. Not here. I'm very bullish the crypto market now, but at some point.
Okay, so let's go there. And once again, I got to pat you on the back as you made a great call on Bitcoin. When we last spoke, it was trading around 85,000 bucks. It did go down to as low as 75,000 bucks in early April. You had a target at that time of 115, or sorry, you had a target of 115,000 earlier in the year, but when we last spoke in late March, you took your target up to 135. Once again, I thought, man, this guy's out of his mind. But you're right, we're not too far away from that now. I think we're around 118 or 120 on Bitcoin.
You'll
So
be there in the next not too long, I think. You'll see that it's within a month. It'll go really quick for the next move here. But yeah, no, but obviously, I mean we are in this liquidity phase. A lot of liquidity is coming in. We see that. We may not have the Fed is cutting, but the rest of the world is definitely supplying liquidity. You've seen all the M2 charts and all that. And this is the phase where people think, oh, everything is fine. You can hear just from the conversation you and I have been having here, what's not to like? Everything is fine. Liquidity coming in, the economy is strong. Why shouldn't I go out to the most risky assets I can find? And then there is the whole narrative of that Bitcoin is the end of be all. I mean, it's just the greatest thing. I don't see that. I see it as a very, very risky asset, and it's a very volatile asset. And I am horrified to see how many companies that are actually starting to bring this into their portfolio, into their balance sheets. I mean, I do not understand that. I mean, we've seen it four times crashing by 70 to 80%, 85%, four times in the past 10 years. How can it be that you want to bring something like that into your balance sheet? Is it because we think, oh, this time now it's not going to crash any longer? It's a very liquidity driven asset. And if you bring it into your balance sheet, you'll risk seeing a 70 to 80% decline. And I think Bitcoin has never seen a real recession, never seen it. So being such a liquid, driven asset into a recession where you're going to see the dollar to 122, as I see it, I can see a lot of havoc coming out of that from a lot of businesses actually having to look to their balance sheets and saying, okay, we have to reevaluate what we actually, and then we have to bring it over the income statement to we have some big losses here, and that can happen, and there will be the likes of MicroStrategy and so on. I mean, he looks like a god these days because he's been doing what he's been doing. We just have to remember that when bubbles are forming and we see these Eiffel Tower moves, there are, an end to it. And Bitcoin is nothing special here. I have to say that I'm sorry for everybody out there who thinks it is, but it's not. It's a very risky asset, and it has been dropping many times. And the adaptation of this is the same like we had the adaptation in the .com area of the small companies back then, .com companies. We have seen it again and again and again in these bubble times, and it's not the same as it cannot drop. It can drop, and it can drop very strongly and very with a great volatility. And I think there's a lot of risk in that market now. It's like the dominoes are now being, lined up as I see it.
the only pushback I would say on your whole thesis is that the current administration is all in on cryptos and Bitcoin and cryptos in general. But the Genius Act was recently passed in the US, the first ever framework for stable coins in the US, which are just digital assets pegged to the US dollar. We've seen many IPOs come to the market this year. There's many more coming before year end. Circle IPO'd earlier this year. It's a stable coin pegged to the US dollar. It's up 180% since it went public. BitGo is a crypto custody company is coming public. Gemini also filed. They're going to be coming public later in the year. So there's a lot of tailwinds, in my view, to the whole sector and why it could keep going for quite a while.
Yeah, we can keep going for quite a while. We know that, but I mean, I turned 50 this year. I was 25 in year 2000, and I remember this also. 1999, we had all the big companies. We had 18 ads at Super Bowl where you had only with companies that would not exist the year after. Then we had IPOs all over the place. with this. We had them, attracting a lot of capital, and the media were all over the place. We had Fortune, we had Forbes, and all that, looking at people and saying, "Oh, these are the new dot-com billionaires and millionaires." What is it that we think that is different this time for businesses that have no revenue, no income, or no profits? That is going to make it such a special thing. Is it because we just come another cycle? We spent this 25 years, and these old boomers here, like myself, maybe you, I don't know, but at least me, that just looking at this and then saying we've seen this movie before, we actually seen something that is scaringly, similar to it. And again, like that point, we were talking about the new economy, right? This time it's the new also economy is digital. And like that also, we had a new technology behind it. We like in the 1920s, we had a new technologies, and we were still a big bubble. It was the automobiles, home appliances, and so on. It was still a bubble, and it burst. In the 1840s, we had the railways, coming out. Also, new technology would have changed the world. Definitely, thousands of companies also went bust. We've seen it before, and that's what happens every time when the fog of innovation comes up. People think, "Oh, I need to jump into it immediately, and I will find, I'll find wealth, I'll become rich." But the thing is, attention is not the same as value. And right now, we see attention to a lot of things. It's not the same as value. And it will come down again. It will come down to the few that will actually deliver the real value to this, that will find out, how is it that we was going to see this technology work and how to bring something real out of it. And there will be a new Amazon out of that, or a new Google. I would hope I could find and identify that, but they're not going to be this widespread. And this is not a new financial revolution or anything of the like. I have to be very clear on that. It's not.
I recently had a conversation with someone who said that in the last 15 to 20 years, the government and the Fed have become very, I guess you could say the markets have evolved to the point where they have far better control over the markets. And
Mhm.
this person said he doesn't think we're ever going to see a 50 or 60% pullback in the S&P like we did back in 2000, for example. And maybe we're going to get these short-term pullbacks like 15 to 20% like the one we had in April, but it's only going to last for a short period of time and it's nothing but a buying opportunity. What are your thoughts on that?
That it's nice, you know, bubble talk. When you have bubbles, that is what you say. Why would we have a pullback? Because liquidity will save us, the administration will save us. I mean, guess what? If that was the case, why haven't we seen it before? Why wasn't it done before? Oh, because now they are more clever. It's the same tools that they have. So we hear that when people cannot comprehend why things have been going on for such a long time. And that's sentiment talking. And when sentiment is talking, I'm getting really scared, because when you start to hear these things, and remember, I think I can't remember how far back you and I go when it comes to these interviews here, but when I was talking in 23 with others, or with you also maybe, saying, when we get to the top of this and we can go back and look at the interviews, we will be hearing that liquidity will be there, the Fed will be there, the administration will be there, whatever it is, we'll make sure, and nothing can break this bubble, and it can break this market. That is what we're gonna hear and that's what we start to hear. So it's going to be more pronounced, and the more dislikes I'm gonna get on my when I say this, and again, I just want to be very clear. I'm very bullish the market right now, and I still think we can have a very big upside still, but it's not the same as this is a new situation, something. It's not a new economy. It's not nothing like that. It is a technology that's coming out. People are getting very enthusiastic, throwing money around. We know some of these crypto things we have going on are just jokes. Obviously, there are AI companies out there doing where there are real value behind, but it's not the same as the value is at the levels we're talking about right now. The value will come out during over the next coming years, like what we saw after the financial, after the dot-com as well. The new technology will start to be to be adopted, and it'll be in a different manner in the whole fog of things that we saw in 1999 and 2000. So it's just for me, it's we're watching something we've seen before. It's so similar, it's so eerily similar, but people again just say, but this time is different. I'll we'll have to see.
So just to summarize everything you said, you think you're still very bullish on the market as we go into year end. You're looking for a top of 7,000, 7,100 possibly, and then all hell breaks loose. And
Yeah,
that's
but maybe not.
by a
But again,
slowdown of
also
the
like
economy and also an increase in unemployment.
like that, yes. And you'll see that the market can stay irrational longer than you can stay solvent. And I mean, I'm not bearish at this point. I'm not shorting the market at this point. Absolutely not. I'm probably the most, my risk. I'm far out on the risk scale at this point here. So I think things can go much higher. But it's about understanding where we stand. When you're standing on the side of that Eiffel Tower, and there may be a little higher to go, but there is a peak up there somewhere. And I just hope I'll be clever enough, smart enough to get out in due time with what I have. So into September, October, yes, strong bull, even though you'll have a pullback during the summer. And maybe even, I mean, I think we need to reset sentiment a little here because it's so bullish right now. So we need to reset it a bit. And probably people start to talk about a double top, and then you'll have this final blow off top. So as I see it.
Yes, there's a lot of speculation out there right now. This meme stocks are coming back to life. We saw this open door go from 50 cents up to $5 in a matter of days. I'm not sure where it is now, but okay, so let's just assume your target on the S&P is 7,000. When we get this pullback, how
Even 7,500. Let me see, like 7,000, but I could see also there are two Fibonacci levels. That's what I'm saying. But there is one, and I could see that crazy spike up to that. But let me just to be that clear, yeah.
and
Sorry.
then but when we get this pullback, how severe can it be? We saw a 50% pullback in from 2000 to 2002. Do you envision the same sort of thing happening this time?
Yep. Yeah, 50% is nothing. I mean, if you look at the stock market right now and the market capitalization to GDP, you have it 200 and some percent. I don't know, haven't checked it just recent 205, more 6%, 7% maybe. In 2007, it was around 104 or 5%. So even if we went to that level, the stock market could halve and you would still be at the level we were in 2007. In 2000, it was at 130%. We could not halve by that, but we could go down quite a lot. I could easily see that we drop to the levels we had into May of 2000 and what was it? Bottom of October 2022. Yes, October 22, right? On the bottom there. I think we could easily see that. That's 3,500. People think I'm crazy. Why would we see that? That's 3 years back. But it just tells us, and when I've called it a blow off top, I've talked about the extended monthly rallies that we have had. And this is what we see now. And when it comes down, unfortunately, these Eiffel Towers, they collapse. So that level would not surprise me at all, because that would be down to 100% on the market capitalization to GDP, 100 and some percent even. Normally, we could see it actually do a shoot under that level that we normally would see on a long-term basis, which could be down at 80, 90%. So 100, would it be crazy to say 3,500 on the S&P? To a lot of people, yes. I think it could quite easily get to that.
Henrik, we started this conversation by you mentioning that you got together with Felix Zulauf, somebody else who I've
Mhm.
interviewed on my channel. Uh, Maybe you can tell us a little bit about the conversation, any insights that came out of that discussion?
Oh yeah, first of all, he's an perfect gentleman, and yeah, we got a chance to talk in beautiful Sylt, and which is just south of Denmark, yeah, south of Denmark in German island. And well, it was a nice conversation. Actually, I think it was enlightening on both sides, and it was interesting to hear also that my methodologies is actually matching what he's doing, and then the way he's looking at things. So yeah, so that was interesting, and I think. Yeah, we agreed to stay in touch, and that's what we do now, and exchange our views.
Well, Henrik, once again, this has been a fascinating discussion. I always enjoy our chats, and I want to thank you for spending time with us today. You've been very gracious with your time. If somebody would like to learn more about you or follow you online or learn about your services, where can they go?
The easiest way is to go to my X channel, so the X which is called at Henrik Zeberg, and you'll find me there, and there'll be links to wherever. Just please be careful with all the scammers out there. Unfortunately, there have been some bad experiences with that in the past year, where people have started sending money to me. I'll never ask you to invest your money for you. So if you ask by that, please be careful. I need to say that again and again, because it's been quite a few incidences now. So find me on Twitter at Henrik Zeberg, and yeah, that's it.
Henrik, once again, thank you. Enjoy your summer.
Thank you. Likewise.